In this video, I want to talk about some concepts and principles that are going to be relevant as I go through the lectures related to the adjusting entries. So first of all, the time period concept, all that is saying that you're dividing your financial statements into time segments. So in other words, you're looking at reports maybe for the year, maybe for the quarter, maybe for the month, maybe for the week, it just depends. But basically, it just says that you're dividing up those reports into time periods so that you can look at a report effectively because you know what time period you're looking at. And then the revenue recognition principle. In this, you're just looking at when to record revenue and how much to record. So when to record revenue, that would be when the revenue is earned. And the generic way to say it is when the product or service is delivered to the customer. And then, of course, you can get detailed with that. Well, when is it considered delivered? When they provide the service? What if they're halfway through the job? You know, we can get into some of these details, and we're going to get into a little bit of that in the next few videos. But basically, the point is you record revenue when it's earned, when the product or service is delivered to the customer. And then as far as how much to record, you're going to record the amount that you are receiving from that customer, whether it's the sale price of your product, whether it's the agreed upon price of your service, or even a discounted price. You would record the actual price you're going to give that customer, not your normal price. So it's basically what amount you're expecting to receive from that sale. And then for the matching principle, you're looking at expenses incurred during a time period, matching those expenses against revenues that were earned in that same time period. In other words, you're just trying to line things up and get them in the right time period. And the revenues are matched up with the expenses and they're on the income statement. So you're looking at revenues minus expenses equals net income or net loss, if you remember from the financial statement video. But basically, you're just making sure things are in the right time period and expenses are in the same time period as the related revenues that were earned in that same time period. And that's all I wanted to cover in this video. These principles, concepts are related to the adjusting entries because we're wanting to make sure things are in the right time period. We're wanting to make sure we're recognizing the correct amount of revenue, and we're dividing things up by time segment. And that's all I wanted to cover in this video. If you have any questions, feel free to comment below, and thank you for watching.